in the case of the gold-silver ratio, that the market can stay irrational longer than we can all stay solvent. And that's really very true. Today is a good example. I mean, the market has been unbelievably volatile today.
I come to the conclusion that leasing is coming to an end, and that is withdrawing huge quantities of bullion, physical bullion, from the market. And the consequences will be seen in the paper markets because they will contract on the back of it.
Wherever the supply is going, there's a fire and they got to put it out. What was the number? 300, 400, 500 tons have been onshore over the last 4 to 6 weeks. And now all of a sudden, first notice day, there's 333 tons standing for delivery. That's your answer.
In today's weekly recap, 3 financial experts, Alasdair Macleod, Bill Holter, and Andy Schectman, talk about the recent events in the gold and silver markets. We watched hours of footage to bring you the best clips so you don't have to. It's been a wild week. Gold surged to new all-time highs. Silver saw a steep sell-off, and the S&P 500 took a beating. The volatility is off the charts, and we're breaking it all down for you. Plus, we'll cover the 2 biggest news stories shaking the financial world right now and how they tie into the future of gold, silver, and the global economy. But first, smash the subscribe button, turn on notifications, and share this video with a gold bug. Enjoy the episode.
The gold was down $80 at one point, and about an hour ago it was actually up for the day, and now it's down about $27. So, you know, when you talk about this whipsawing, yet only giving back less than 1% on gold isn't the case right now with silver, which is down $2 to right at $32 or just above. Certainly and I guess if I had to summarize it, to me, it's almost like there's a clear effort to flush the managed money out of their long silver positions on COMEX, and maybe it's to allow these commercial banks to cover at lower prices. I don't know, but certainly today was one heck of a volatile day, not just for precious metals. I mean, look at the markets themselves. The Russell 2000 index officially has entered bear market territory for the first time since 2022, and NASDAQ down almost 6%, and you know the markets are getting clubbed. And then you have Secretary Besant saying, yeah, that the collapse of the market is not a MAGA problem, it's the MAG 7 problem. And we talked about last week on your show that the MAG 7, when you talk about the hedge funds having their lowest allocation to the MAG 7 in over 2 years, you know, things are certainly starting to get very interesting, as they say, which of course is the Chinese curse. When you live in interesting times, these are not for the faint of heart, for sure. Well, let's not forget about the dollar, which has lost 35% of its purchasing power against gold in less than a year. And so it's not just the volatility we see in silver, but the volatility in the dollar too. And that's the thing people need to remember, is that we're valuing everything against dollars, but gold's rise of 35% just since the beginning of the year would signal that the dollar has lost 35% of its value against gold in the last year. And now you have the Fed pricing in a 70% chance of rate cuts in June, and the yield on the 10-year falling. Again, you're looking at the potential of dollar weakness going even further and further and further. So, I mean, you make a very valid point, but I would also add to that this fiat system, as you mentioned, is beginning to show cracks, and it's you know, this global confidence that's underpinning the dollar's dominance seems to be wavering a bit, especially with what Trump is doing with the tariffs and what the markets are saying. And when you see the Russell 2000, which is the broadest measure basically of the economy, all the small caps, the businesses getting hammered, I think it's time to buckle up a little bit. I'm not making a statement on where I think gold and silver are going, but I'm just simply saying that the markets are telling you right here and right now that they're concerned about what's going to happen the rest of the year.
In today's news recap, silver tumbles on trade war, demand concerns. Silver fell to $31 per ounce on Friday, the lowest level since January 29th, bringing weekly losses to over 9% as the escalating trade war fueled concerns over global demand and recession risks. China's finance ministry announced on Friday that it would impose a 34% tariff on all U.S. goods starting April 10th, retaliating against the duties imposed by the Trump administration earlier this week. Trump had announced on Wednesday a 10% baseline tariff on all imports, with higher rates targeting major economies, including China 54%, the EU 20%, Japan 24%, and India 27%. Trump even taxed Chile with a 10% tariff on Argentina. Equities and commodities took the hardest hit in the sell-off, while investors flocked to safe haven assets like government bonds. Despite the broader market slump, silver and other precious metals may receive renewed support as recession fears intensify, with traders increasingly pricing in potential Federal Reserve rate cuts in the months ahead. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Contracts. But just understand, people for years have said, when's it going to happen? You're watching a failure to deliver happen. You're watching the nuts and bolts of that happen. I mean, think about this, Chris. If you go back 10 years ago, I would bet that there were not 300 or 400 tons for the whole year delivered. And you cannot print gold, you can't print silver. So if somebody's standing for delivery, and they don't accept a 20% profit bribe, they want the metal instead, this will end in a failure to deliver. That's going to happen. Is it immediate? Well, it looks like we're in the process of just simply because of what's standing for delivery in both silver and gold. It's going to happen fairly soon. Yeah, otherwise you get a failure to deliver and then COMEX is done. I mean, the COMEX gold fails, COMEX silver fails. And what does that mean to all the other contracts outstanding? Like, corn, wheat, fuel oil, interest rates, et cetera, et cetera. If you prove two contracts to be completely, a complete fallacy where they can't deliver, my past partner, Jim Sinclair, used to pose the question, what is a contract worth if it cannot perform? And the answer is zero. And he posed the possibility of seeing COMEX gold at $10 an ounce offered, no buyers, and physical gold bid at $50,000 an ounce and no sellers. Also, I mean, yeah, you've got some people who believe that, and I'm sure have acted on it. So you've got some flow because of the tariff news, but I don't think tariffs are a real underlying reason to be onshoring or for London, Switzerland to be sending, buku amount of gold to the United States. I mean, I think it's pretty obvious. In 300, 400, 500 tons have been onshored. I mean, you don't have to be a rocket scientist to put those two data points together. Russia's reserves were confiscated, stolen, whatever you want to talk about, or whatever you want to call it. From that day forward, gold has done nothing but go higher. And that makes sense because foreigners look at Russia having, what was the number, $300 billion sequestered. And foreigners are saying, well, hey, if they can do it to Russia, they can do it to us. And what that's done is it's mobilized foreign sovereign treasuries, foreign central banks to offload treasuries, and they're buying gold with it. And you mentioned another 45,000 contracts. If you look at the volume for the day, I think it was a very low number, like 7,500 contracts or something like that traded. So if that's what traded, then how did they open 45,000 new contracts?
In today's news recap, silver tumbles on trade war, demand concerns. Silver fell to $31 per ounce on Friday, the lowest level since January 29th, bringing weekly losses to over 9% as the escalating trade war fueled concerns over global demand and recession risks. China's finance ministry announced on Friday that it would impose a 34% tariff on all U.S. goods starting April 10th, retaliating against the duties imposed by the Trump administration earlier this week. Trump had announced on Wednesday a 10% baseline tariff on all imports, with higher rates targeting major economies, including China 54%, the EU 20%, Japan 24%, and India 27%. Trump even taxed melee with a 10% tariff on Argentina. Equities and commodities took the hardest hit in the sell-off, while investors flocked to safe haven assets like government bonds. Despite the broader market slump, silver and other precious metals may receive renewed support as recession fears intensify, with traders increasingly pricing in potential Federal Reserve rate cuts in the months ahead. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Observed the movements in the past going into the back entrance of the Bank of England. In fact, I used to lunch with the head of the foreign exchange department occasionally in the Bank of England. And we used to see these trucks going in. I mean, I think it was really 2 days a week. You get about 5 or 6 trucks going in and out and all the rest of it. And you'd never know what they were actually carrying. But there is a logistical problem. The other thing I would say, Andy, is that I don't really regard the Bank of England vault as a major storage point for commercial entities. It's basically for central banks. So if commercial entities are taking gold out of the vaults, then I'm fairly certain that this is going to be leased gold. Now, this is important because I think if you look at the leasing operation, leasing, swap, whatever, if you look at that, Frank Venerosa wrote about this back in the late 90s, and also he spoke particularly at, I think it was 2002 in Lima, where he concluded that possibly between 10 and 16,000 tons, and that's between a third and a half of all central bank gold, was out on lease at that time. And as he put it, was adorning the necks of Asian women. In other words, it had gone into the market and wasn't going to come back. So there is this problem, I think. Now, I think that following that, basically the way the Bank of England worked it was book entry transfer. In other words, we can arrange for gold to be leased to you as a commercial entity. But it remains in the Bank of England vault because it's got to remain in a vault somewhere. If you're using it, let's say for collateral or whatever it might be, then there's no need for it to move out of the vault. So this becomes what they call a book entry transfer. So in other words, you instead of having the stuff delivered into the market and disappearing, you had 2 owners, if you like, of the gold in the Bank of England's vault. So, it didn't appear that there was a problem. I think the importance of this development recently is that this gold is now being arbitraged out of the Bank of England vault and into COMEX. The other side of the COMEX problem, I think, is the stands for deliveries. Now, I don't know who the hell's standing for delivery, but I'm pretty sure it's not swaps, it's not bullion bank trading desks or whatever. I mean, because apart from anything else, you had this situation which has forced a huge great premium on the futures, which has created this arbitrage in the first place. If it was just a matter of the establishment swapping chairs on the Titanic, you wouldn't get the premiums on COMEX. the reason that this stand for delivery, I think, is so important, and nobody seems to be mentioning it, is that if you work out the stands of delivery over the last 4 years, up until the end of last year, it was around about 2,000 tons, 2,100 tons, something like that. That is a huge amount of gold. But since the 1st of January, those stands for deliveries have accelerated at a rate whereby, if that's maintained, it would be something like 1,700 to 2,000 tons this year alone. In other words, the pace of stands for deliveries has accelerated very, very sharply. Now, undoubtedly, this might have something to do with, Trump. Basically, you stand for delivery if you want gold and you don't want dollars. Really what you're doing is you're selling dollars and you're buying gold. But as we know, if you stand for delivery, you don't necessarily get delivery. That is something that sort of you have to keep on badgering to actually get. Now, put yourself in the shoes of, if you like, the establishment, if you like, which is faced with all these liabilities discharged. Because legally they should deliver a stand for delivery, so they can't ignore it. And they have the problem that if we get tariffs, then my goodness, we don't have enough gold to match this. So they had to create this enormous flood of gold into COMEX warehouses in order to cover their stands for deliveries. And I think that's basically what's happened. But the interesting thing, Andy, is look at the phases. First of all, the one that Veneroso identified, and that is that